All right, first up, we always share the portfolio transparently so you know how my portfolio is doing and what stocks I own if I'm talking about them here on YouTube. And if you like that kind of stuff, just do me a favor, like the video, help more people find it, and subscribe to the channel so you never miss an update. $57,800. We're up $1,500 today for almost 3%. Since inception, February 15th, 2022, we're down, this says 34%, but we're down $13,000, and we've put $71,000 in. Reminder, we put in $1,500 every 2 weeks, and I share every step of the way right here. And so here's a look at the positions in the portfolio and how they're doing today. We got Snowflake up 5% today. Crowdstrike's up almost 3, Datadog's up 2, Gitlab's up 6, Tesla's flat, the trade desk is down 1.6, Rocket Lab's up 1, MongoDB is up 2, and Cloudflare's up almost 2. What happened with Zoom? We're looking at price to sales ratio. It got up to 80 towards the end of 2020. That is insanely high. The stock price was $560 a share. And it has since dropped down to a price to sales ratio of 8. And the stock price is $113 a share. So from November 2020 to now, yes, terrible investment, down 80%. But what if we take that COVID craziness out and somebody had invested in Zoom on IPO day or at the IPO, $62 a share, and they held it till now? They're still up 21% per year. That is an amazing, amazing return. If an investor can earn 21% a year, that's legendary status, and that turns, that creates generational wealth over time. So with some of these companies, real companies, COVID was chaos. It was craziness. Nothing made sense. That's easy to say in hindsight, right? I got swept up in it. A lot of people did. We all made mistakes. If we zoom out a little bit and remember we're investing in companies, we're looking for great companies, buying them at reasonable valuations. That's the lesson learned for a lot of us, myself included. But we're looking for great companies. 3 years is a short time horizon when you think about actual investing, and still a fantastic return for Zoom. And so that's point number one. We need a little perspective. But point number two is, what does the future look like for Zoom, and is it a good investment right now? First, what I like to do when I'm looking at a stock is to look at the business results. And if the business has outperformed analyst expectations, if we remove stock price. If we remove stock price from the equation, this is every quarter that Zoom has reported since they became public, since they were a public company. Every single quarter, they have beat on earnings and they have beat on revenue. That is a great sign for a company. The other thing I want to focus on here is the insane growth of this business. In July of 2019, the second quarter 2020, they reported $145 million in quarterly revenue. In July of 2021, they reported $1 billion in quarterly revenue. They almost increased their quarterly revenue by like 8 times in value over the period of 2 years. That is insane execution and insane adoption. If we look at earnings estimates for future years from analysts, and again, this is just a gauge, and if we look at this, beyond 2026, there's only 2 analysts with their estimates in, but let's just look at this. So for earnings, we're looking at in 2026 a price to earnings ratio of 20. But that's with 30% year-over-year growth, and then they're bringing it down essentially to 16% growth, which could be conservative, honestly. And so that brings us down to 17 the next year, 15, 12, 11, 9, 8. And yes, this is a lot of years from now, but the point is that they have the ability to continue growing their earnings, and that price to earnings multiple is going to get lower over time. Same thing with revenue, right? Analysts are expecting 10% revenue growth, and then 13% revenue growth, 11%, 17%, 14%. So, in the mid-teens range, and over the next 10 years, that brings it down to a price sales ratio of 2. 10 years is a long time, right? So we don't have to think about it on that time frame. But even if we look out to 2025, 2026, still at a very reasonable price sales ratio when we think about the market that they're in and the growth ahead. If we take a look at Morningstar, Morningstar is considered a pretty respected analysis. Sometimes it could be a little bit of a trailing indicator because it takes them a while to update things. But they even think Zoom is a 4-star stock, meaning it's undervalued in their opinion. And so they've got it at a 29% discount to fair value. And that it looks like that valuation was established March 1st, 2022. And so the fair value is 160. The 1-star price would be 280. That's where they think it's, very overvalued, and a 5-star price down to 80. That's only like 20% lower from here for it to be at a 5-star price, which sounds like a lot, but that's just normal volatility in growth stocks. They give it an economic moat of narrow and standard capital allocation. They point out that they think customers with $100,000 in trailing revenue remain a bright spot. That was up 46% year over year to 2,916. Enterprise customers drove 52% of revenue. I'm going to talk about that. They expect that to continue to increase. Let's take a look at the slides from Zoom's latest earnings report, which was, again, from May timeframe. This is what I want to point out, and this is what that Morningstar note pointed out. They're seeing strength in enterprise customers. They saw from the fourth quarter of 2021 to the fourth quarter of 2022, they saw enterprise customers grow by 35%. This defines kind of what happened with Zoom's diabolic growth in stock price. In the fourth quarter of 2020, 25% of their revenue came from online and 75% came from enterprise. With all the craziness from COVID over the next year, that shifted to 56% from online and 44% from enterprise. What is online? That's, either single people or businesses with less than 10 employees coming in and signing up for Zoom to do meetings and webinars and things like that. That just exploded after COVID, and it completely shocked really the world, and the stock price shot up. But it threw off their entire business strategy and plan, and it just threw things out of whack, right? And so they were working on the enterprise growth engine, which takes a little bit longer to grow. And when they got so much single customer revenue, it was great, but I think management knew it was temporary, and the stock price shot up, but then eventually as some of those single customers rolled off the platform or stopped spending more money or whatever, it started to impact growth a little bit. And fortunately, they're still able to remain, positive revenue growth. But it's just corrected a lot, or it's a high bar that they have to match. And what this shows is just the strength in their enterprise offering. And so now, in the fourth quarter of fiscal year 2022, they've brought that back to 50% enterprise and 50% internet, or single, smaller users. And so the net dollar expansion rate for enterprise customers was 130% in the fourth quarter, which is really what we want to see. That means the largest customers, the ones that spend the most money, are growing revenue 30% per year from existing customers. And this is the other thing I want to point out about Zoom is, for as expensive as it got from a stock and how much it kind of threw off the business model, what the last 2 years did was just give them more free cash flow and a stronger balance sheet than they could have ever really imagined. And so now, coming out of the fourth quarter of 2022, they've got $5.4 billion in cash. When we think about a macro constrained environment, a possible recession, people want to own reliable companies that aren't going anywhere. And with $5.4 billion in cash, Zoom is about as safe as it gets in terms of stocks, in terms of like solvent businesses. So they had $209 million in operating cash flow and $274 million in adjusted free cash flow. One of the fears that still exists with Zoom is that things like Google Meet and Microsoft Teams are a threat to the business. And why would anybody, enterprises included, pay for Zoom when they can get that for free from Google or whatever? I think that narrative is actually missing the point a little bit. And Zoom offers, and they're working on improving this platform, which is what they announced today. They're offering a all-in-one collaboration and hybrid workforce solution where you can have everything from whiteboarding and brainstorming and planning to meetings to webinars to phones, corporate phones, all under Zoom, which right now there's no other offering that has anything like that. And so if they can do that, if they can execute on that and it gets adopted, which the numbers show that it has been adopted, there's a lot of potential upside to Zoom because the future of work is hybrid. It's not remote, it's not in person, it's hybrid. There's gonna be people in office, there's gonna be people not in the office. And so if Zoom can do this, if they can continue to execute and get adoption, the business has great potential. And so what this Zoom One is doing is offering, it brings together options for persistent chat, phone, meetings, whiteboard, and more into a single secure and scalable package. Also a new translation feature that allows meetings to be translated between English and any of the 10 languages or from those languages into English. And this quote gets kind of to the point of what I was just saying. Simplicity is at the core of everything we do. As the Zoom platform has evolved from a meeting app to a comprehensive communication platform, it was clear that introducing a new packaging like Zoom One was the next step in the company's evolution. By bringing together chat, phone, meetings, whiteboard, and more in a single offering, we're able to offer our customers solutions that are simple to manage so they can focus on business issues that matter most. This is Fast Graphs, and right now we're just looking at a graph that shows kind of the price to sales multiples on the right side here. That's what these numbers are. And then analyst expectations for, we're looking at sales growth right now over the next 3 years through 2025. We can see that right now it's showing a blended price sales ratio of 8. And so if we take this and we look at what the return would be if Zoom maintains its price to sales ratio of 8 and hits those analyst expectations over the next couple of years, you're looking at an 11% annualized return for a 32% total return through January 31, 2025. Is that lights out amazing 100% returns per year? Nope. 11% though beats the S&P 500. On average, it returns 8 to 10% a year. 11% per year would be a pretty fantastic return if that's sustainable over time. So what could change that return? Well, if Zoom trades at a lower price sales multiple, which is certainly possible, maybe it trades at 5, maybe it trades at 4, who knows, then that certainly hurts those returns. If it trades at a higher price sales multiple, those returns go up. If it gets to 14, which I think is unlikely, unless revenue accelerates, then you're looking at 37% annualized, so huge difference there. The other factor could be revenue growth, either missing or beating expectations. There's a chance that everybody is underestimating Zoom right now, and these expectations are way too low. And maybe the revenue growth is 20% per year. Then those numbers look a lot different. Or maybe it's flat or negative because of a recession. So then the numbers look different to the low side. So there you have it. We saw the growth potential, some estimates, some return potentials, some ranges. And where I'm left at is that Zoom is not a screaming lights out buy right now. But if we think about it in terms of the risk of the business going under, I think it's pretty unlikely that the business goes under because of that cash position and their operating and free cash flow. So pretty reliable there. Wouldn't be surprised to see Zoom buy back shares or pay a dividend at some point. I mean, they're in innovation mode right now, but they got a ton of cash or do some acquisition or something. There's just a lot they could do with that money. And so I like the companies I own better right now. Zoom is certainly one pretty high on my watch list that I'm considering. But I don't think it's unreasonable to think Zoom is a great investment right now if it fits, what an investor might be looking for, especially when we think about the execution that they've shown through COVID, the cash position, and then the market that they're in and the upside potential. And the narrative's is about as bad as it could be in Zoom right now. And so definitely on my watch list, and would love to hear your thoughts on Zoom in the comments. Let me know what you think.